Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by Lana Chen. And Lana, today we are talking about a stock that just had one of the cleanest earnings days you will see all year. United Rentals, ticker URI, reported Q1 2026 this morning, April 23, 2026, and the stock surged more than 16% on the print.
That is a massive move for a $60 billion industrial name, Hudson. Revenue came in at $3.985 billion, a Q1 record. Adjusted EPS landed at $9.71 against a $9.06 estimate, and adjusted EBITDA margin expanded 60 basis points to 44.1%.
So we went from $806 and change at yesterday's close to $977.81. That is not a routine beat and raise reaction. That is a re-rating.
Exactly. And the analytical hook is a metric called OER productivity. United Rentals reported 2.3% for the second straight quarter against a 1.5% inflation bogey. That tells you they are winning on pricing and utilization simultaneously, which is rare in this part of the cycle.
So today we are going to unpack the business, the numbers, the bull case, the bear case, and what every investor needs to understand before chasing this move. Let's get into it. Lana, for listeners who do not know the name, what does United Rentals actually do day to day?
United Rentals is the largest equipment rental company in the world. They rent out everything from aerial work platforms and earth-moving equipment to specialty power generators, HVAC units, and fluid solutions. The company traces its roots to 1997 and has grown primarily through acquisitions. They now operate roughly 1,625 locations across the U.S., Canada, and Europe, with more than 870,000 rental units.
Think of them as the Home Depot tool rental aisle, but at industrial scale. If you are building a data center, a semiconductor fab, an LNG terminal, or a highway, you are calling URI to rent the cranes, the lifts, and the power you need on site.
The business breaks into general rentals, specialty, which includes power, HVAC, and fluid solutions, trench safety, and used equipment sales. The Ahern acquisition back in 2022 added major fleet density, and management has a repeatable M&A playbook stretching back to RSC in 2012 and Baker Corp in 2018.
26,000 employees, headquartered in Stamford, Connecticut, and $60 billion in market cap. This is the national champion of equipment rental. Let's talk about the man at the helm, Matthew Flannery. He has been president and CEO since May 2019, but his URI story goes much further back.
Flannery joined URI in 1998 when the company acquired McClinch Equipment out of Connecticut. He climbed through field operations, regional VP, senior VP, then EVP and COO before taking the top job. He is a Hofstra University graduate, and unlike a lot of CEOs, he genuinely came up from the branch level.
That field operations background shows up in his obsession with OER productivity. He treats it as the North Star metric for the entire company. It is not about renting more units. It is about extracting more revenue per unit of fleet time every quarter.
And under his tenure, the specialty rental build-out has accelerated meaningfully. Specialty carries 40 to 50% EBITDA margins compared to 38% for general rentals. That mix shift is very deliberate, and it is Flannery's strategic signature.
All right, Lana, the stock ripped 16%. Is it still cheap, or did we just miss it?
At $977.81, URI trades at a trailing PE of 18.96 and a forward PE of 15.78. EV/EBITDA sits at 13.75, and the price-to-sales multiple is 3.72. Market cap is $60.87 billion.
So even after the surge, this is not a 40 times earnings software stock. This is a mid-teens multiple on an industrial leader.
Correct. And the forward EPS projection is where it gets interesting. The 2026 forward EPS projection sits at $51.09. The 2027 forward EPS projection is $58.50. The 2028 forward EPS projection is $66 flat. If URI delivers on that trajectory, you are paying roughly 15 times 1 year out and under 15 times 2 years out.
For a company growing EBITDA margins, returning capital aggressively, and riding a multi-year infrastructure cycle, that is demanding. Historically, URI has traded between 12 and 17 times forward earnings, so we are still inside that band.
Beta sits at 1.32, so it is more volatile than the S&P, but the valuation reflects the cyclicality. The market is not treating this like a permanent growth compounder, and that asymmetry matters.
Let's get into the actual print. Walk me through why the market reacted so strongly.
Revenue of $3.985 billion beat the $3.915 billion estimate by $70 million, up 7.2% year-over-year, a Q1 record. Adjusted EPS of $9.71 beat the $9.06 estimate by 65 cents, up 10% year-over-year, also a Q1 record. Net income came in at $531 million.
And the EBITDA line is where I think the real story lives.
Adjusted EBITDA of $1.76 billion with a 44.1% margin, up 60 basis points year-over-year. That margin expansion in a Q1 is what signaled to the market that pricing power and mix shift are real, not just a one-quarter artifact.
Then there is fleet productivity, the OER metric we keep hitting on.
OER came in at 2.3% above prior year, clearing the 1.5% inflation bogey comfortably for the second straight quarter. Management also raised full-year guidance. Total revenue guide moved up $100 million to $16.9 to $17.4 billion. Adjusted EBITDA guide went up $50 million. Gross CapEx guide rose $100 million, which tells you they are seeing more demand, not less. And they committed roughly $2 billion to shareholder returns in 2026.
That is a rare combination. Beat on the top line, beat on the bottom line, expand margins, raise guidance across the board, and invest more into the fleet. That is why you get a 16% move. How is the street responding?
The analyst rating is buy. Out of 44 analysts, 33 buys, 8 holds, 3 sells. The average price target is $1,050. Post-earnings, JP Morgan raised their target to $1,050 at overweight. Morgan Stanley went to $1,100, also overweight. Jefferies bumped to $940 but kept a hold rating.
And the bear on the street?
Barclays is the loud bear. They kept an underweight rating with a $600 target. Their thesis centers on non-residential construction deceleration and the risk that URI's premium multiple compresses in a cyclical downturn. It is a defensible concern, not a throwaway call.
So the balance of opinion is clearly bullish, but the bear case is coherent. That is actually a healthy setup. You do not want unanimous agreement at the highs. Let's talk about the financial picture underneath these numbers.
EBITDA margins at 44.1%, and that is industry-leading by a wide margin. Total debt sits at $13.8 billion, with net debt to EBITDA at 1.9 times, flat quarter over quarter. Equity is $9 billion, total assets are $30.1 billion, and cash on hand is $500 million.
1.9 times leverage. What is the ceiling they managed to?
Management targets a 2.5 times ceiling, so they have meaningful room. Operating cash flow over the trailing 12 months is around $5.9 billion, which funds both CapEx and capital return.
And on the return of capital, we have a dividend of $6.32 annually, yielding 0.65%, with a payout ratio of 14.7%. Plus a fresh $5 billion buyback authorization on top of the $1.9 billion already repurchased over the last 12 months.
Correct. Between the buyback and the dividend, management has flagged roughly $2 billion in capital return for 2026. That is a material shareholder yield when you add it to the underlying earnings growth.
Let's make the bull case. I count 5 pillars, Lana. Walk me through them.
First, the infrastructure supercycle. The IIJA is still in early deployment phase, and large project revenue grew 18% year-over-year, driven by data centers, semiconductor fabs, and LNG terminals. Second, specialty rental acceleration. Power, HVAC, and fluid solutions are growing faster, with 40 to 50% EBITDA margins versus 38% for general rentals. Management is targeting 25% plus of rental revenue from specialty by 2027.
Third pillar is fleet productivity upside. OER is running at 2.3% against a 1.5% bogey for 2 straight quarters. If it hits 3% through construction season, full-year guidance becomes conservative, and we get another upward revision.
Fourth, capital return acceleration. A $5 billion buyback authorization with leverage at 1.9 times gives management optionality to be aggressive. Fifth, consolidation optionality. The industry remains fragmented below the top two players, and URI's M&A playbook from RSC to Baker Corp to Ahern has been repeatable and accretive.
Put those five together, and you have a business with secular demand, expanding margins, a capital return engine, and optionality on both organic productivity and inorganic growth. That is a compelling stack. All right, now push back. Give me the bear case, honestly.
First, construction cycle deceleration. Non-residential construction is rate sensitive. Any commercial real estate pullback or industrial capex slowdown hits utilization directly, and URI's premium multiple compresses fast when that happens. Second, tariff-driven fleet cost inflation. Roughly 40% of the fleet is sourced from manufacturers exposed to steel and aluminum tariffs, which could mean structural capex cost increases.
Those two feel most pressing given the current macro backdrop.
Third, leverage in a rate cycle. That $13.8 billion in debt at 1.9 times leverage is manageable today, but an EBITDA decline could push toward the 2.5 times ceiling quickly. Fourth, execution risk on the specialty build-out. Branch openings, workforce, fleet procurement, any of those can slip, and cost overruns would disappoint a market that isn't paying up for that mix shift.
And the fifth one?
Sunbelt competitive intensity. Ashted's U.S. build-out is aggressive, and price wars in fleet-dense markets would erode OER. That directly threatens the metric the entire bull thesis rests on. So, if I'm pushing back on Hudson's bull case, I would say the whole stack hinges on OER staying above 1.5%. If OER slips, the premium multiple evaporates faster than anyone expects.
Let's look at URI against its rivals.
The closest pure-play rival is Herc Holdings, ticker HRI, with a $3.44 billion market cap, a PS of 0.79, and revenue growth around 5%. Will Scott Mobile Mini, ticker WSC, is a $3.93 billion cap with PS of 1.72, but revenue growth is negative 6.1%. Caterpillar has a PS of 2.18 with revenue declining 10%. Fastenal, the industrial distribution rival, trades at a 5.52 PS with revenue growth of 4.5%.
So URI at 3.72 times sales is a clear premium to the rental peer set, but well below Fastenal.
The spread tells you the market views URI as structurally better than Herc on scale and specialty mix, but not as defensive as a distribution compounder like Fastenal. The valuation gap between URI and HRI is the cleanest read on URI's operating leverage and specialty premium.
And that makes sense. URI is the national scale leader with a specialty mix none of these rivals can match, and that deserves a premium. What are the options telling us, Lana?
Put-to-call ratio is 0.72, which is a bullish skew post-earnings. Open interest is concentrated in the 1,000 to 1,100 call strikes. We saw notable call sweeps at the 1,050 October 2026 strike with $3.2 million in premium, alongside hedge puts around the 800 October 2026 strike.
So institutions are positioning for more upside into year-end, but they are also buying downside protection. That is a mature book, not a meme chase.
On the insider side, CEO Flannery surrendered 420 shares at $820.58 for RSU tax withholding. That is a routine transaction tied to vesting, not an open market sale. He still holds 121,336 shares, worth roughly $117 million at the current price.
So that Form 4 is not a bearish signal. If anything, the size of his remaining stake tells you he is meaningfully aligned with shareholders. All right, Lana, let's bring it all together. Q1 record revenue, Q1 record EPS, 44.1% EBITDA margins, raised guidance across the board, a $5 billion buyback, and OER running at 2.3% against a 1.5 bogey. The stock ripped 16% and the analyst community is raising targets.
And the watch point is unambiguous. OER productivity is the one metric that decides whether the bull case or the bear case wins. At 2.3% for 2 straight quarters, URI is generating real pricing power. If OER trends toward 3% through Q2 and Q3 construction season, 2026 guidance proves conservative and we see another leg higher. If OER slips below 1.5, the premium multiple compresses quickly.
As Flannery himself said on the call, the data center and infrastructure build-out is creating a multi-year rental cycle, unlike anything we have seen since the post-financial crisis recovery. and URI is the only company with the national branch footprint and specialty capabilities to capture all of it.
For investors willing to accept cyclicality and watch OER quarter by quarter, URI is a reasonable core industrial holding at 15.78 times forward earnings. For investors who believe non-residential construction is about to roll over, Barclays' $600 target is the floor scenario you have to weigh. The answer depends on your cycle view, not your opinion of the company.
Operationally excellent, fairly valued, cyclically exposed. That is the URI profile. And ChargedAlpha.com is where you can find every episode in the series. Thank you for listening to Charged Alpha.
This podcast is for informational and educational purposes only and should not be construed as financial, investment, tax, or legal advice. Nothing discussed in this episode constitutes a recommendation to buy, sell, or hold any security, including United Rentals. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. Listeners should conduct their own research and consult a qualified financial advisor before making investment decisions. The hosts and Charged Alpha may hold positions in the securities discussed. Thank you for listening.
Ooh, we do. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.